Hey, Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you get sort of value or entertainment out of these videos, all I ask you to hit thumbs up and subscribe. Questions, comments, put those below. I want to touch this week on the Bank of Canada's rate hike, 50 basis point increase, the single largest rate hike we've seen in over 20 years. Again, typically they move in 25 basis point increments, so we had a 50 basis point move. We discussed this at length on the Loonie Hour, so again, I highly encourage you to go check out our podcast, not only on YouTube, but on Spotify and Apple Podcasts, etc. But I want to kind of provide my own opinion here outside of the Loonie Hour and really kind of take a sort of focus on how I'm perceiving this in the housing market, because I think, as everybody's well aware, is the housing market in Canada, it is systemic, right? I mean, at the end of the day, it's around, give or take, 20% of GDP. It ultimately has it's Canada's largest contributor to sort of household net worth. At the end of the day, commercial banks, so all of your big five Canadian banks, you might think your house is your asset, but it's actually the bank's asset. And so, they're kind of incentivized to obviously support home values. So housing prices are systemic. So that's why when people say, oh, it'd be great if house prices just dropped 20%. Like, who cares? It would only be going back, 3-4 months of price growth. Not a big deal. I mean, it's not, that sounds nice on the surface until you actually unpack the banking system. Wiping out 20% of the Canadian banks, collateral, it doesn't go over very well. What happens is you tend to see a freeze up in bank lending. Capital basically gets impaired and it freezes lending even further. So keep that in mind as we kind of walk through this rate hike increase, because everyone's talking about the Bank of Canada and how hawkish they are, and they're going to raise rates to 250, 300 basis points, and everything's going to be fine, and they're going to fight inflation. And I'm kind of making the argument that, when your total non-financial debt to GDP in Canada is 350%, do you really have an ability to fight inflation? Because once you start actually normalizing interest rate policy, you actually sort of ignite the debt bomb that is, and then you start talking about, again, financial stability. And so keep in mind that everything the Bank of Canada has been talking about, if you watch their press conference after the rate hike, they're assuming that there's not going to be any real impact on the housing market. They're assuming that the economy and the consumer can actually withstand these interest rate increases. That is what they're saying. That is what they're telling you. That is their own assumption. So for all of you guys that are out there and saying, oh, they're going to raise rates 200 basis points and the housing market's going to crash, the Bank of Canada is telling you we're going to raise rates 200 basis points and the housing market's going to stay flat. So there's a bit of a disconnect here. And I want to unpack this a little bit further. That was Carolyn Rogers' own comments. She basically was of the view that housing sales and activity would moderate. It would stay elevated, but there would not be any drag on the economy. And what we're already seeing is a really, I would call it borderline a collapse in home sales activity. We've gone from just kind of this peak FOMO activity in January, February, to sales activity has really dropped off a cliff over the last 4 to 5 weeks. And yes, you're still seeing the occasional multiple offer, but that's predominantly because there's still extremely low inventory levels after 2 years of the biggest housing boom that we've ever seen. So it's going to take some time for inventory to slowly replenish. But if you look at sort of new mortgage applications and have conversations with mortgage brokers, housing activity is falling, and it's falling very, very rapidly. You're already seeing prices correcting 5 to 10% in parts of the suburbs. And so it's kind of ironic, because I had this conversation with one of the big bank economists. I'm going to leave his name and his company out of it for all intents and purposes. But so he was on there on social media and he goes, oh, our view is that the Bank of Canada's terminal rate, which is the rate at which they will stop raising interest rates, will be 3%. And so if you guys need clarification, the last time the Bank of Canada got stopped out and was forced to lower interest rates was at 1.75%. So last rate hiking cycle, the Bank of Canada was able to push rates up to 1.75 before ultimately cutting rates. So he's saying we're going to get rates to 3%. And I said, okay, fair enough. But I said, just out of curiosity, and this is not a critique, if you're able to get rates, the terminal rate, the overnight rate to 3%, which would probably leave your variable rate mortgage at about, 4.5%. I said, how much in your view would housing prices thus fall? And he goes, well, they wouldn't fall. Why would they fall? Households are building savings. The economy is strong. The job market's strong. We got immigration. I'm going, interesting. Because again, suburban house prices are already down from the peak, 5 to 10%. But that's not going to show up in any home price index for the next 4 to 5 months, just the way that data is collected. So these guys, like, they don't actually live in the real economy. If you actually like gone out and talked to the average person, like last time I checked, you've got, rising inflation, so you've got rising food prices, rising fuel prices, the cost of living is getting crushed. I think that people are disgruntled in society. I think there's a rising sort of angst and populism that's growing because the middle class is basically evaporating. Household debt to GDP is horrendous. Probably by Q1 of next year, you have household debt servicing ratios hitting all-time highs. And this guy's saying, well, the household's in great shape. And I'm going, well, buddy, like you're already seeing a correction in housing, and rates. The Bank of Canada's rate is at 1%. So you're telling me it's going to get to 3%, and there's going to be no change in housing. Again, I would implore some of these economists and these Bank of Canada people to actually go out and talk to people in the real estate industry and to go talk to people every day. Like I said, housing sales activity is falling precipitously. The last time so we got mortgage rates at 4%. I don't have to remind people again, the last time mortgage rates hit 3.5%, on much lower prices in 2018, housing sales activity in Greater Vancouver dropped to an 18-year low, and in the Greater Toronto area, home sales dropped to a 10-year low, and they would have probably stayed extremely low, and prices were already falling in those two markets. They would have probably kept falling, but what happened? The Bank of Canada and all the other central bankers started cutting rates and re-engaging in quantitative easing, aka a version of money printing. So I think it's just how people live really in fantasy land. These central bankers are not your friends. These guys, remember, a year and a half ago, here let's just rewind to sort of the onset of the pandemic. Tiff Macklem's comments right here.
Our message to Canadians is that interest rates are very low, and they're going to be there for a long time. We recognize that Canadian businesses are facing an unusual amount of uncertainty. And so we have been unusually clear about the future path for interest rates. If you've got a mortgage, or if you're considering to make a major purchase, or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time.
So he basically goes out and implores Canadians to go and blow your brains out on leverage. Rates are going to stay low for a very, very long time. And what he meant by very, very long time was actually in his monetary policy report at the time. He said we will keep rates basically at zero until the end of 2023. Well, here we are at the beginning of 2022, and he's already raised rates by 75 basis points, the largest one-off rate hike in 20 plus years. And he's telling you we're going to keep aggressively raising interest rates. They got inflation completely wrong. They also got housing being transitory completely wrong. You'll remember 12 months ago, he was saying housing's transitory, it's just pent-up demand. And then home prices ripped another 20% nationally post his comments. So these guys have been wrong at every turn. And my personal view, again, personal view, it could be wrong. My personal view is they're going to be wrong again because I think it's all, kabuki theater. I think it is all kabuki theater. It's all largely made up. We fight inflation, but again, when debt to GDP in Canada is at 350%, you really don't have an ability to fight inflation. And housing prices are such a massive component of the economy that if you just go ahead and kill 20% of your economy, you start talking about financial stability. So you won't be talking about inflation, 6 to 12 months from now. You'll be talking about financial stability, aka, hey guys, house prices are down 10% nationally and falling. and bank lending is contracting, aka your credit growth, which is the lifeblood of an economy, begins contracting and decelerating aggressively off of 10-year highs, we'll be talking about financial stability. We won't be talking about inflation. So that's kind of my views. And again, ultimately, yes, I know the Bank of Canada is predominantly tied to the U.S. Federal Reserve. Their picture over there is even worse. I mean, once you start getting the Fed hiking rates, the U.S. dollar starts to strengthen, you're probably going to tip that economy at some point into recession. That then deteriorates U.S. debt to GDP ratios even further. So, you know, the U.S. government, public sector debt to GDP is at 130%. So that's going to impair that picture even more. So the reality is what I've been calling people that believe that you just can go back to normalizing interest rate policy is that you really can't, because the system is essentially insolvent. And this has kind of been the theme of these videos for, I don't know, last couple of years. And so we're going to test that thesis again. And again, people are going to feel free to dunk on me as the Bank of Canada raises rates another 25, 50, 75 basis points before ultimately triggering something and having to reverse course, because I think that's ultimately what's going to happen. So that's really my view on monetary policy. Again, you can love it or hate it. I didn't create the system. I didn't, lever the system up to the levels that it's at. It's just what it is. Ray Dalio talks about this a lot. It's kind of the end of the long-term debt super cycle. There's really no way of going about this without some sort of ultimately debt restructuring. And so, that's kind of how we're looking at things right now. So as always, hope that helped, and we'll see you next week.